Welcome to Dailystocks Europe. Today we're diving into the UK's largest self-storage REIT, Big Yellow Group Plc. A business built on space, simplicity, and long-term cash flow. In this breakdown we'll cover the company's business model, financial performance, long-term strategy, major risks, and how Big Yellow compares to European REIT peers. Big Yellow is a FTSE 250 self-storage operator with around 109 UK stores and a market capitalisation of just over £2 billion. The company provides secure, flexible storage solutions for individuals and small businesses, generating predictable rental income and high operating margins. Big Yellow was founded in 1998 by industry veterans who saw early potential in branded, premium self-storage across the UK. In 2007, Big Yellow converted into a real estate investment trust, enabling it to distribute most profits as dividends in exchange for tax efficiency. Today, Big Yellow's network spans major UK cities, with its strongest presence in London and the South East. Self-storage demand thrives on urban living, home moves, small flats, e-commerce logistics, and life events, creating a steady flow of new customers. Individuals use storage during moves or renovations, while small businesses rely on Big Yellow for inventory, tools, and archival space. Big Yellow earns revenue primarily from weekly and monthly storage rentals, supported by secondary sales such as boxes, locks, and insurance products. The company's strong brand allows it to charge premium rates, especially in high-demand London neighbourhoods. Unlike many rivals, Big Yellow owns nearly all of its stores freehold or on very long leases, giving it full control and long-term asset value. Self-storage is highly scalable. Few staff and low maintenance costs lead to store-level operating margins of around 70%. Across the UK, Big Yellow is the most recognised storage brand, giving it a competitive edge in customer acquisition. Over the past 5 years, Big Yellow's share price has been volatile, rising strongly before the pandemic, peaking in 2021, then falling sharply in 2022 as interest rates surged. Like all property REITs, Big Yellow is sensitive to interest rates. Rising yields lower property valuations and pressure rental growth. In late 2025, shares jumped nearly 20% in a single session following reports of takeover interest from Blackstone. Revenue has grown consistently for 7 years, supported by new store openings and strong post-pandemic rental demand. Occupancy typically sits in the high 70s to mid-80s. New stores start low but mature steadily over a few years. Despite big swings in headline profits from property revaluations, Big Yellow's underlying earnings remain stable. IAS 40 property revaluations cause large non-cash gains or losses each year, making net profit an unreliable long-term indicator. With a loan-to-value ratio of around 13%, Big Yellow maintains one of the lowest leverage profiles among European REITs. Around half the debt is fixed rate, reducing interest cost volatility during rate cycles. As of 2024-2025, Big Yellow trades at a 15 to 20% discount to its net asset value, a common theme across UK REITs. As a REIT, Big Yellow distributes at least 90% of rental profits, resulting in a consistent dividend policy. Dividends have nearly doubled over the past decade, rising from around 21p to 45p per share. At today's share price, the stock offers a dividend yield of just over 4%. The dividend is well covered by recurring operating cash flow, a key strength of the self-storage model. Big Yellow's growth strategy focuses on new store development, digital optimization, and sustainability initiatives. With 14 new stores in the pipeline, many in Greater London, the company expects a meaningful uplift in future earnings. Recent developments such as the King's Cross store show Big Yellow's focus on prime, high-visibility locations. New stores typically take 2 to 3 years to fill to mature occupancy levels, temporarily diluting earnings but creating future growth. The company uses competitor tracking and yield management tools to adjust pricing in real time and maximize revenue. Automation enables extended access hours and reduces staffing needs, contributing to Big Yellow's industry-leading margins. Solar retrofits across dozens of stores have lowered energy costs and improved EPC ratings, strengthening both resilience and ESG credentials. The company is testing battery storage to capture more solar energy on site, an innovation that could further reduce energy costs. Through its charitable trust, Big Yellow supports hundreds of local charities with free storage space at each store. The main risks center around interest rates, inflation, slower economic activity, and competitive pressures. Higher yields reduce property valuations and can temporarily depress Big Yellow's net asset value. Building new stores is more expensive due to inflation in materials and labor, affecting project returns. Competition from SafeStore, SureGuard, and independent operators keeps pressure on pricing and local market share. While long-term demand is strong, overbuilding in certain regions could weigh on occupancy. Compared with European peers, Big Yellow has lower leverage, a premium brand, and a more concentrated UK-only footprint. Historically, self-storage REITs have significantly outperformed the broader real estate sector, both in growth and stability. Big Yellow stands out due to its disciplined balance sheet, prime city sites, strong brand recognition, and pricing power. Future performance will be driven by new store openings, digital improvements, and gradual increases in occupancy and rents. For investors, Big Yellow offers a mix of reliable income, high-quality assets, and long-term structural demand, but remains sensitive to interest rates. In summary, Big Yellow is a strong, well-managed REIT with stable cash flow and long-term growth opportunities. The business is assisted by urbanization and the UK's limited storage supply. Despite recent valuation pressure, the fundamentals remain solid. Thanks for watching this Dailystocks Europe deep dive. If you enjoyed this analysis, subscribe for more clear and concise research on European stocks. See you in the next video.